Hi, and welcome to the Retirement Education Hour. I'm Megan Mozak, and I'm here in the studio with Kirk Cassidy and Dr. Paul Metler. Kirk and Paul, they are financial instructors with the Retirement Education Foundation. And this show is brought to you by the foundation and its mission to help you become educated around all things retirement planning. And that is certainly an important thing to have and to be confident in this day and age. There are a lot of moving parts when it comes to retirement, and this show and the foundation aim to help you walk away with confidence and walk into a retirement you are excited about. Kirk, it's great to be back with you. And, I want to talk about this great topic we have today as we dive into this retirement program. Sometimes I think we look at retirement and we see it in two dimensions. You either are successful, right? You pass, or you're not successful and you fail. And you say that's actually not the best way to look at it because at the end of the day, there's a lot of opportunity there in the middle. Tell us about that.
There is, Megan. We wanted to take this show, take a little different approach than I think, honestly, we're guilty of doing as well. People tend to look at retirement as fully about risk mitigation, which it is, but really driving fear into those potential retirees as opposed to the opportunities that will come from retirement. But when I'm saying this, certainly retirement will provide opportunities for you to do a lot of things that were on your bucket list and that you wanted to accomplish and do that you've never had time for. That's certainly what retirement's about. But when we say let's stop being so pessimistic about planning for retirement and just focusing on the fear, let's focus on some of the opportunities and be optimistic about it. And it doesn't have to be just a pass fail. Our industry, and I'll continue with the theme you guys always hear me say, is our industry loves to sell fear. Fear provides the opportunity to sell you their services, their products. It allows them to get you focused on spending less, because remember, the less you spend, the more we in the financial service industry makes. So fear is good for the financial service industry. The more afraid you are, the more money we make, and the easier it is to sell things to you. So we're going to focus today on some of the opportunities that proper planning and being optimistic about retirement lends to. So, for example, the 3 to 4% rule. That is the most ridiculous rule that has ever existed. It's a rule based upon laziness. It's a rule based upon the less you spend, the more we make. You actually can retire and take withdrawals at the age of 60, 62, 65, 67. You could take withdrawal rates of 6, 7, 8, 9% withdrawal rates, sometimes even a little higher depending on your asset mix, the types of assets, IRAs versus non-IRAs, 401ks versus not 401ks. So there are opportunities for you to spend a lot more money in retirement. Therefore, you can retire earlier. So, in fact, the opportunity to retire earlier gives us the ability to make your retirements often more tax efficient. It allows you, when you're healthier, to spend more and enjoy more. You are going to significantly reduce your spendings towards your mid to late 70s. So the earlier we retire, the more that we can spend, the more of the dream things that we've dreamt about we can do. So today we're going to explore some of these different opportunities. We're going to throw in a lot of strategies that I think are important, but at the core of all of what we talk about in all of our radio shows is the goal that we as a national charity have of getting you to attend one of our 8-hour, what is like a master's level course. These courses are taught in 2 evenings or one full Saturday. They are taught at major universities and colleges around your areas. And we also stream them live from the university so that you can participate and ask questions as if you are at the university participating in these 8-hour courses. All we ask is for a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
Now, as we talk about this today, Kirk, and boy, I love this topic because I think there is this almost this fear mongering that goes on. You think, oh boy, I'm going to get to the end of my working career and it's either going to work to retire or it's not going to work to retire. There's a lot of pressure built into that for people, right? So, for our listeners today who are feeling that pressure, what would be your message to them about these opportunities that they may have?
Well, first, stop looking at this as a pass fail. It's not. I mean, your retirement, it should be graded. And as well as the teams you hire should be graded. It shouldn't be a probability of success. It shouldn't be a dial. It should be, how do I optimize for income, minimize for taxes, mitigate risks? And by the way, the better you understand how they are mitigating your risks, during a 30-year retirement, the more freedom you are going to have to spend and enjoy your retirement. And I'm telling the listeners, I hope you're hearing us. And by the way, if you notice, Paul's running a little late. He'll be here in a few minutes. If you've noticed his voice hasn't been on yet, he'll be here just a few minutes. But what we're telling our listeners is stop letting them scare you into protecting your principal. You don't need to protect your principal. You can have a controlled spend down of your principal. You can spend 6, 7, 8% withdrawal rates. You can retire earlier if you understand the risk mitigations that they've put in place for your 30-year retirement. If you know that we're going to have, and I'm going to tell you, you're going to have 3 to 6 major market events through a 30-year retirement. You're also going to have different administrations you're not going to like. You're going to have presidents that you don't like, geopolitical issues. There are going to be fears and external noise and external problems all around all the time that you have no control over. But if you understand the risk mitigation pieces that are, and there's a lot. If you understand those, you will have greater freedom to take advantage of the opportunity of all the free time you have in retirement as you have earned after 40 plus years of working, 90,000 plus hours of working. You enjoy this. And that's what the charity's about. That's what our 8 hours, and it is truly, I'm not lying, it's like a master's level course. It's advanced, it moves fast, there's a lot of information. You guys are more than welcome to come as many times as you want till you understand it. But you need to understand it to be able to enjoy your retirement and take advantage of these opportunities. So if you'd like to register, all we ask is a $29 donation to charity. Go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back. There's plenty more straight ahead. You're listening to the Retirement Education Hour. And we're back. Glad you're with us today for the Retirement Education Hour. Megan Mozak alongside Kirk Cassidy and Dr. Paul Metler. Kirk and Paul, well, you hear them week in, week out right here on the show. They're both financial instructors with the Retirement Education Foundation. Of course, we've been telling you about the foundation and its mission, and it really is to help you feel empowered and confident about your retirement future. And that starts with education. And so these courses that we've been telling you about here on the program, we want to see you there. This is a way for you to do something, be proactive, take an actionable step toward your future. If you're in these courses, you're going to walk away with so much information, so much education that previous generations just didn't really need. But today, with all the moving parts that you see, you really do need to understand what it takes to plan for an ideal retirement. I want to give the information for you to be at these courses. And the courses are held at major colleges and universities. They're almost like a master's level course on retirement planning. We want to see you there. So make plans to attend. You can go to retirementplanningedu.org. That's retirementplanningedu.org. You're going to see all the available options there for the dates that these courses are held, the locations, and I'll mention these locations for you. University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, Columbia College as well is on that list. So wherever you're listening today, we've got locations near you, making it easy and convenient for you to attend. Now, if you'd like to call to reserve your spot, you're welcome to do that. Just pick up the phone, 800-240-8981. Let them know you'd like to reserve a spot at the courses, the retirement planning courses. Again, that's 800-240-8981, or go to retirementplanning.edu.org. And I want to get back into the topic we have for you today on the show. I should mention that if you missed the first part of our show, or maybe you want to listen again, you can do that. Listen as a podcast. You can download it wherever you find your favorite podcast. Search for the name of our program, Retirement Education Hour. All right. So, Kirk, we're talking about how we should view retirement. So many people, especially in the financial industry, they try to categorize retirement as a pass or fail. You either get an A or you get an F, right? And I can almost feel that anxiety that exists out there for people who are getting near the doorstep of retirement. And you say that's not the best way to look at it, that really your retirement should get a letter grade. And the letter grade you get is oftentimes based on the opportunities that you have within your retirement planning process. I want to talk about pensions. Not everyone has the luxury of a pension, but this is a decision point and really an opportunity point for so many people, right?
Megan, it is. Look, so it isn't a pass fail. And I feel this is another example of pass fail when it comes to pension lump sum. I think people make emotional decisions on whether they should take the pension versus the lump sum without really understanding the math. And you can create reinsure and create your own pension with some of the money, not all of the money. There's a lot of options and ways to go with pensions versus lump sums. There's not a one size fits all. And those of you, and I know we have a lot of our, this is an automotive industry in Michigan. I know we're in different markets in podcasts around the country, but particularly in Michigan, where we are recording right now, this is a big automotive industry. And we've got a ton of engineers and execs that are really smart who love to do their cost benefit analysis, and they think they're looking at life expectancy, and they think they know the math. The math they don't know. I'm just telling you right now, you don't know the math. Go to the charity's website. We have a webinar specifically on pensions versus lump sum so you can better appreciate the math. We talk about this a ton in the class. It's really it comes primarily down to a tax problem first, life expectancy second. There's a lot of variables, married, not married, surviving spouse. There's a lot of variables on whether or not you should take a pension versus a lump sum. But I'm going to let the genie out of the bottle here. The opportunities are massive, and particularly with our friends in the automotive, Ford, GM particularly, in the last 5, 6 years, we have probably had, I don't know, 5, no, probably more. I probably over 1,000 of our engineers and executive friends through the charities courses. Maybe more than that, actually, as I'm thinking of it. Um, and as they've come through our course, what they've learned, I mean, it's like 100% of the time you should be taking the lump sum for Ford and GM. 100% of the time. In the difference, the math equation, it's like $1 million over your lifetime difference by doing this right versus doing it wrong. And it's not as simple as just making the decision. Then you have to strategically set up your retirement plans effectively to optimize this opportunity. It's a massive opportunity. But again, let me pull back a little bit. Let me pull back a little bit and say, we've got people at different industries in this community that have been through our class. And when we've done the analysis to look at whether they should take the pension or lump sum, sometimes it's been pension, right? Ford and GM, I'm telling you guys, it's lump sum. I hope you hear me. I know it's some of you don't want to hear that. You need to attend the class so you understand it's not close. Go to the charity's website, watch the webinar. Some of the other, I mean, like Comerica Bank, there are other uh, um, uh, uh, there are help me out, Bobby. Sorry about that. There are other industries and employers that have the pension lump sum where pension is better. But it's a math problem. You got to understand the math problem to optimize for tax. Because look, here's the deal. Most of you are going to way underspend what you otherwise should spend in retirement because of fear, because our industry tells you not to spend, all of the above. They're also going to tell you not to touch your money out of your IRAs and your 401ks until you're forced to, which, by the way, is often not the right answer. But they're going to tell you that. And what you're going to find when you start doing some calculations of what are the value of your IRAs and 401ks when you're in your mid 70s and in your early 80s, and see how much required minimum distributions you have to take out. Plus, you have your pension, all taxable income. Plus, you have your Social Security at that point, because of all of that, will be very taxable income. You're going to be hundreds of thousands of dollars of forced taxable income. And if you had taken the lump sum, you could actually Roth converted some of that lump sum pension into Roth IRAs at a very low tax bracket, reinsured whatever percentage you needed to reinsure so you could create your own pensions, but at a controlled tax rate. And now you have not, and if you die early, you haven't given up control of the asset. So you have control of the asset, you have insured income, you have greater tax efficiency. Megan, this is a home run. And this is why people need to attend these 8-hour master level courses. We're going to teach you things the industry will not teach you because it requires a lot of work, it costs them money, and they make less. So if you'd like to attend one of our 8-hour courses, go to retirementplanningedu.org. That's retirementplanningedu.org.
Glad you've joined us. This is the Retirement Education Hour. Great show for you today. And of course, I'm alongside Kirk Cassidy and Dr. Paul Metler, both financial instructors with the Retirement Education Foundation. You might be listening today thinking, I don't know, am I going to pass or am I going to get a failing grade when it comes to retirement? You can put all that anxiety to rest because this is really about the opportunities you take and it's about grading your retirement. You've got a lot of great opportunities, as Kirk and Paul have explained today. And the financial industry, they want you to think it's either pass or fail. And we've been outlining some of those opportunities that you can proactively seek out and get the right help on to dramatically change your retirement if you're doing all the things right. Here's another thing that you'll want to keep in mind. Speaking of doing things right, getting educated. And that's what the foundation aims to do, educate you on all things retirement planning. And that starts with their courses. These courses, as we tell you, they're really like master's level courses on retirement planning. They're held at major colleges and universities near you. And those locations include the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College. You can go through that list, pick a date to attend, find all that great information at the website, retirementplanningedu.org. That's retirementplanningedu.org. Or you can call to register 800 240 8981. All right, so pass or fail, we can forget that. This is about opportunity. And I want to talk about the opportunity we have when it comes to our investment mindset and philosophy. Because so many of our listeners, Kirk and Paul, they think, well, I've got to do this. I've got to be active. I've got to be in there choosing mutual funds, looking at the market every day. But you guys say there's a different approach here. This is a really distinct opportunity that can have a lot of positive implications if handled correctly.
Yes. Okay. So are we all ready? And I know our listeners are going to not be ready for this, but let's all be ready and finally accept the fact that none of us can stock pick or market time. There's not an active manager who has successfully beaten the S&P 500 over the last 20 years. In fact, over the last 10 years, there 94% of actively managed mutual fund managers are losing to the S&P 500. I'm going to review data here and show numbers and talk about numbers here that is going to prove to you that no matter how good you think you are at investing, you're not. Neither am I. Neither is Kramer. I mean, Kramer on TV is underperforming the S&P 500 by greater than 100% over the last 20 years. Our industry is full of you know what. And you can stop the game. You don't have to worry anymore about trying to stock pick, market time, or even choose mutual funds. It's not hard. The investing part of retirement is actually quite simple. Paul, it doesn't take it's more about when am I taking my income will determine what I should be investing in. And it's all about passive investing, Paul. It's passive buy and hold. In our next segment, we're going to talk about pivot accounts, right? So, as long as we construct an appropriate retirement plan, and that's not asset allocation, it's where I'm taking income from when the market is up, where am I taking my income from when the market is down, then we can have a more passive investment philosophy and we're going to drive much better results and returns.
Yeah, you say that, but what's interesting is you still meet people every day in our classes where they show you an example of their investments and they're 60, 70, 80 different individual stocks and they're convinced that their advisor knows what they're doing. And in fact, I think they feel like if the advisor isn't actively trading, they have no worth, no value. And I think advisors often feel that way. If they're not trading and not buying, they're not, that's their secret sauce. That's their value. The problem is because they don't plan, that's the only value they really bring to the table.
Well, that is the value proposition they're bringing to the table, and it's not very valuable because, there has been more research done on this. It's done. The fight is done. The argument is done. There is no argument around active versus passive. Passive always wins over any extended period of time. And none of us can. Do you know when the best, Paul, you know this, when are the best times in the market?
After the worst times.
Boom.
Yeah,
Look,
right.
see, I didn't even see, he knows. 78% of the best time in the market, 78% of the time occur during bear market events.
78% of where the market's going up is after a bear market.
That's right.
Yeah.
So the idea that we can get in, out, be that,
Right.
it's impossible. And here's the sad part. This is supposed to be the opportunity. We're glass half full today,
Full.
Paul.
Full today.
We're full, and Paul's here now, right? So, yay. He got stuck in traffic, unfortunately. So listen. Here's the deal. I want to be half full. I think, Paul. I think people get obsessed with trying to find the silver bullet. People get obsessed with there's got to be an angle here, and there isn't. And what's different about retirement than during the accumulation phase? I mean, I hate to tell you. Let me take a step back. I just want to give you some data because and it's going to upset some of you because you guys have worked really hard trying to choose your investments. You subscribe to different web newsletters. You watch different TV shows. You read different articles. And here's the deal: in 1980, Paul, if someone invested $100,000 in the S&P 500 in 1980 and left it alone until 2022, so for 42 years, from 1980 to 2022, $100,000 turned into $10.8 million. Now, here's the catch. If they just missed 10 of the best days over that 42-year period of time, 10 days, just 10 days, their $10.8 million turns into $4.8 million. If they miss 50, how about 30? Let's see, they miss 30 of the best days in 42 years, Paul. It's 1.7 million versus 10.8 million. Is that incredible?
How many days you said? 30?
30 days, it goes from 10.8
That's
million.
nothing. When you
That's
think
nothing.
about it,
No.
that's people go out for a lot longer. That's nothing.
And so I'm going to interrupt you. So, because here's why. During the financial crisis, 65% of retirees panicked and went to cash right at the bottom. 65% panicked and missed. Many of them aren't even back in the market yet. Never got back in the market. During COVID, 35% of people panicked in March, right after we had a 34% drawdown. What was it, in 21 days? Then we had the best 52 days in market history after 35% of baby boomers panicked. This is the optimistic part. Go ahead.
What's the opportunity?
The opportunity is you don't it's not this difficult. You map it out so that you're have different types of investments for different market conditions to pull your money out of. This is why you have to attend one of our 8-hour classes. If you'd like to register for one of our almost master level courses in university settings and stream live across the country, uh, go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll return with Kirk and Paul right after this. And we're glad you're with us. This is the Retirement Education Hour. Megan Mozak back in the studio with financial instructors Kirk Cassidy and Dr. Paul Metler, both with the Retirement Education Foundation. And maybe you visited the website that we've given you, but you have not yet actually registered for the course. I want to challenge you, do that today. There's no time like the present to do something that your future self will thank you for. And this is a course you deserve to be at, you need to be at. You owe it to yourself. If you want to have a great retirement, it starts with education, and there's no better place to get that education than at these courses sponsored by the Retirement Education Foundation. And here's that web address again so that you can get registered. The spots fill up so quickly. So get your seat right now. Go to retirementplanningedu.org. That's retirementplanningedu.org. Here's the phone number. You can use this as a way to register. 800-240-8981. Jot that number down and make the call. 800-240-8981. These courses are held at the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College. So make plans today to be there at the foundation's courses. Now, I want to get back into this great conversation we're having today. And so many people in the financial services industry, they'll say something like, oh, if you don't have a plan, or if you don't have this one thing, or you don't have this, you're going to fail at retirement. And Kirk and Paul, they're here to tell you that thinking, it's antiquated. This is not how modern retirement works. There are so many opportunities. And really, this is about grading your retirement. It's not about pass fail. Now, obviously, you want an A. And the good news is these opportunities that they're outlining today, if you can take advantage of them with the right assistance, you've got a really great shot to potentially get that A on your retirement exam, if you want to call it that. So I want to talk about, we were mentioning earlier in the show, we talked about managing your investments, right? Passive versus active. And if you say we should be taking more passive approach now, well, what happens though if the market's down? How can we be responsible so we don't lose it all?
So this is a great topic. It's a probably, I think, the single most important topic of the 8-hour class. We spend a lot of time on this, Paul. This is something you guys who listen to us regularly know we talk about. It's called sequence of returns risk. I- I- When when you attend the class, what you're going to see is you're going to see someone who is accumulating wealth when they're younger. If you took $1 million and invested for 20 years in the S&P 500 and it's performing at 10%, it's going to perform incredibly well. I think the number is like $6 million 20 years later or more. If I take that same scenario, same investment, same 20-year period, same performance in the market, same 10% average rate of return, but then take out 5% a year to live on, they run out of money in 17 years. The sequence of your returns matter when you are taking money out of your account, and people very much struggle understanding, because when you pull money out, you are compounding those losses. So you cannot do that. I mean, the secret to being able to have 6, 7, 8, 9% withdrawal rates is you can never take money from or rebalance a portfolio when the market's down, ever, period. Full stop. No one should touch the account if the portfolio's down. That's a full stop. So then what do I do if I'm retired? And this is why this is the opportunity you have. You don't have to chase it anymore. You don't have to try to stock pick market time, choose investors. You can actually build and construct your retirement plan so that when the market's up, I'm taking my money out of my aggressive accounts. When the market's down, I have something called pivot accounts. In those pivot accounts is we teach the why, but the how in the 8-hour class. That pivot account, Paul, is a non-correlated to the stock market account. And it can be accomplished by a number of different examples.
Right. It could be CDs, could be
Yep.
bonds, could be treasuries.
Now,
Theoretically,
careful. One thing on bonds: short duration bonds. This is very specific stuff. Pivot accounts. I'm going to let you go back, but very specific. I don't want to oversimplify, but pivot accounts are very specific.
they are. I mean, some people, Kirk, would consider cash. I
Yep.
mean, we meet people who think, okay, I'll just put $500,000 in cash.
Yeah.
Not a great pivot account.
I don't like it, but
Don't like it, but that is a pivot account.
yep.
If I can add, I think intuitively we understand the importance of pivot accounts. We understand that as long as you're taking money out of a non-correlated asset related to the stock market, and you never take money when the market's down from an account, you're gonna be great. The problem is people psychologically think, oh my God, I'm not gonna get enough growth. If I have a couple $300,000 sitting in a short duration bond fund, I'm not gonna get growth. I'm gonna run out of money. That's a misunderstanding, is it not?
I love that, Paul. You teed that up for us because here's the deal. There's a difference between average rates of returns and real returns. Just please come to a class. I beg you guys, and we'll teach you. We'll lift the hood of the financial industry. You're not going to like what you see, but you'll understand what's actually going to drive your performance. Your performance, your real returns are going to be driven by never, ever, ever taking money from a portfolio or even rebalancing a portfolio when it's down. Never, ever locking in those losses. Therefore, it will recover. But that a pivot account, Paul, is what, yes. So, yes, you have a non correlated asset, which theoretically, if you were younger, a non correlated asset would mute your returns and cause worse performance. But when I'm retired and I am forced to take my withdrawals to live on, I'm forced to take my withdrawals for R&Ds, whether I want it or not. I'm going to be forced to take money out. I have to have a pivot account, a non-correlated asset, so that my accounts that are down. So remember, you're going to have 3 to 6 major market events through a 30-year retirement, and none of us can predict it. If we can't predict it, then if we have just a pivot account to always go to during times of volatility, then two things. I'm going to drive more real return. I am going to understand my risk mitigation so I won't be fearful. Therefore, I will never change my spending patterns based upon any short-term market events that may be occurring around me that I can't control. And I'll be okay. I know I've got this account that this is what it's for during these times. And if it's constructed properly, like we teach you in the class, that pivot account actually, if done properly with your allocations, can sustain 8-10 years for markets to recover before I need to refill my income buckets. So please do yourself a favor. Attend one of our 8-hour master level courses taught at major universities and colleges in your area, like master's level courses. We also stream these live while we're in the university so that you can participate wherever you're at in the country. All we ask is a $29 donation to charity. Go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back right after this. And we're back. This is the Retirement Education Hour. Megan Mozak here in the studio with financial instructors Kirk Cassidy and Dr. Paul Metler, both with the Retirement Education Foundation, the sponsor of our show, by the way. Education really is the priority here, helping you walk away with confidence, both with this show and also the master's level courses that they teach. And these are courses that, boy, it's going to be a deep dive. There's a lot of materials, very meaty, as you might say. You're going to really be able to sink your teeth into these courses. So much is covered, so many different areas. And it really does lend itself to a course like this now, the retirement planning. It's changed so incredibly. It's evolved. And now so much of it, it's on your shoulders. So if you're not feeling prepared, if you do feel some anxiety around your retirement future, you owe it to yourself to be at these courses. I do want to tell you, they fill up fast. These are packed every time. So we want to see you there. Be sure to go to the website right now, retirementplanningedu.org. That's retirementplanningedu.org. or you can call 800-240-8981. That's 800-240-8981. And you listen to Kirk and Paul week in and week out. This is a chance to meet them, ask questions, really dive into the material, and again, walk away with confidence. That is the goal. So get registered. Go to retirementplanningedu.org. Just to keep in mind where these courses are held: University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, University of Missouri, and Columbia College. Again, get the details at retirementplanningedu.org. All right, marriage. I want to talk about marriage today because when I hear the financial services industry bring up marriage as it relates to retirement, it is all doom and gloom, right? It's all about, all the negatives that could happen. What if, and they'll say something like your spouse predeceases you. Who speaks like that? I don't know,
Yeah.
right?
I know. I know. That's what, Megan, that drives you crazy because we talk about it a lot,
I'm
actually.
like, don't say that. How about
Don't say that. Stop saying that.
Yeah, just say like if your wife or your husband dies before you. But they got this financial jargon. Anyways, but you say stop looking at all the negatives. There are so many positives around marriage with retirement planning. I'm going to take notes here on this because I'm married. What you got?
Right, exactly. So look, today is about, the glass is half full, continue the opportunities. There is no doubtedly a lot of risks when someone is married and the spouse dies, right? And so our industry has really recently, it's something our charity's been talking about for over a decade, right? And they've latched onto this and now they're selling planning around this, that they're really not doing planning. They just sort of talk about it. What I want to do is I want to put a little different spin on it. Look, marriage and finance, generally speaking, there are a lot of stressors related to that. Proper planning provides an opportunity for a more healthy marriage. This is anecdotal, and we usually don't talk about our private practices, but I can tell you in our practice, divorce rates are really, really low because both the spouses understand what their plan is. They understand the risk mitigation. We have solved for whatever individual anxieties or personalities they each have. One wants to leave a legacy, the other one doesn't. One's more of a spender, the other one's a saver. Someone's worried about outliving their money, the other one doesn't care what's left at the end.
Someone gives a lot of money to the children, the other one doesn't like that.
Yeah. Some wants to give more to charity, some don't. So planning in advance provides opportunity for a happier marriage. Planning in advance now, not once something happens, provides for better outcomes when, not if, something happens, because something is going to happen. One of you will die. And there's a 70% chance that you're going to need long-term care. So one of you will likely be a caregiver, and then the other one won't have a caregiver. There's all these things. The tax trap is real, folks. When one spouse dies, it's massive. And we spend a fair amount of time talking about all of the opportunities because as a married couple, you get to file joint. That's an opportunity, massive opportunity, a much better opportunity to reposition assets and minimize taxes when you're married. Your healthcare is actually less expensive when you're married than versus when because you have a caregiver. There's opportunities to plan and structure things. Now, there's also, Paul, and I'll give it to you, but there's something we talk about, and he's smiling because I hog the time all the time. There's something called disclaiming, right? And we're not going to explain it today, but I'm going to tell you one of the things we spend time in the class is giving you the ability that when the spouse does pass away, the surviving spouse pays little to no income taxes, provides better legacy opportunities for the children if there are. There's just so many opportunities when someone's married and in such a better tax bracket with more deductions and more flexibility.
Yeah, I mean, I think what you're saying though, Kirk, is people should get married not just for love. Is that what you're trying to say? Like love is only one piece of marriage.
Social Security benefits, healthcare benefits,
that's right.
tax
That's right. So all of
benefits.
you who are single that want to get married, listen, don't just do it for love. Do it for financial benefits, right? Here's the funny thing. I've been listening a lot lately to radio and to what other people are saying. And it is true. There just seems to be a lot of people out there who focus more on the risks rather than the opportunities, right? I mean, it really is. And
Yes.
the risks related to being married because someone dies, something bad happens. And so much of it is about creating fear because I think the belief is if you're afraid, you're going to come and see them, right? If you're afraid, you're going to do something,
Fear
right?
drives everything.
Fear drives behavior. I think the
Yes.
problem is that oftentimes people get overwhelmed with fear and they do nothing, right? We don't want that. But so much of it's fear based. The reality is being married provides a lot of benefit in addition to love and companionship and all those things, right? It really does. There's financial benefits to it. And we talk a lot about that in the class.
We do, Paul. So again, as a reminder, these classes, they are 8 hours, sometimes longer, actually. Almost master's level, taught at major universities and colleges in your area, and we stream them across the country while we are live. These aren't like on demand streams. These are live. We're teaching the classes, the instructors are teaching the classes, and you are in the charity's educational environment so you can participate. They're taught over 2 evenings or one full Saturday. Um, be ready, strap up. And if you can be in person, I would highly encourage you to attend in person. These classes are really designed for that, $1 to $10 million families. Everyone would get benefit from it, but that's the core of these more advanced strategies. If you'd like to register, all you have to do is go to retirementplanningedu.org. That's retirementplanningedu.org.
And we'll be back. More Retirement Education Hour coming up next. We're glad that you've tuned in today. What a great show as we're helping you relieve some of this anxiety you might have about a pass fail mindset around retirement, right? This is not about will I make it or will I won't. It's really about the quality of the retirement you'll have. It's about giving yourself a grade. And the good news is there's a lot of levers that you can pull, a lot of opportunities along the way as you're doing that retirement planning to bump up your score a bit, right? A little extra credit, improve that B, make it an A. And so, what we've really learned today is that the financial services industry, they're so focused on scaring you and making you think one false move and you're going to fail, you're going to ruin your entire retirement future. It's really more about advantages and opportunities and working with the right person and the right group to make that plan and take advantage of those opportunities. It really does come down to education. And of course, that's what the Retirement Education Foundation is focused on. That's the mission. It's the whole thing. It's why this show exists. It's why the courses that we tell you about happen. And they happen all the time at major colleges and universities near you. These are like master's level courses. So go to the website now and sign up, retirementplanningedu.org. When you go, you're going to see the following locations: the University of Michigan, Eastern Michigan University, Michigan State University, Novi and Troy campuses, Oakland University, the University of Missouri, and Columbia College. Go online now and reserve your spot. We want to see you there, and you can say hi to Kirk and to Paul and the other financial instructors that hold these courses. Again, go to retirementplanningedu.org or call 800-240-8981. It's not all fear and doom and gloom. It's not an A or an F, right? It's not pass fail. It is about opportunity, but really it comes down to planning so that you can take advantage of these opportunities, right?
It does, Megan, and I rarely do this, Paul. I rarely take the show prep and like read it directly from here, but it was so well done. I think it says a lot in just a few words that are really valuable. I hope our listeners are listening because retirement should not be a reason for fear. It should be a season of freedom, right? So retirement should not be a season of fear. It should be a season of freedom. In the way we accomplish this, the way you can accomplish an A rated retirement, not pass fail, fear based retirement, it's through education. It's through education, A, and then proper planning. But none of you, I am very confident that there are very few people listening today across the country through our podcasts and our radio shows have a comprehensive plan. And if they do, I'm very confident they don't understand it, right? So most people don't have one. I'm just telling you, I know how smart you 1 to 10 million dollar people, engineers, executives, CPAs, attorneys. I know how smart you guys are, but you don't have a plan and you don't understand it. And without a comprehensive plan, and at least understanding what it looks like, what it should have, the levers that are involved, then you can't identify whether you can do it yourself or you should, or what team you should have. That is the purpose of the charity, is to give you the levers so you understand what to look for, to find the teams to help you, and then you have to have the education. Without it, you're going to have fear. If you don't know the risk mitigation, the levers, and everything that's happening in the whys, you're going to have fear, and now it's pass fail, and you're gonna way underspend what you otherwise should spend, and your advisors won because you spent less. The less you spend, the more they make, Paul.
It's true. I loved the saying, and I wanted to say it one more time because I
Yep.
think, you said that quickly, and you said basically retirement should not be a season of fear, but a season of freedom. And
You said it so much better than me.
well,
Gosh,
I had the
I
opportunity to listen
stumbled
to you first.
three
So
times.
so when you think about what does that mean, freedom, right? I wish we had an hour. I guess we do in a class, right? That's where we
Eight
talk about it, right?
hours.
We have 8 hours, but this idea of freedom, we say it so like it's like we I don't know, means nothing, or it's so easy. But really, freedom is what it's all about in retirement, right? Most people want to retire and they know they don't have life forever. They're not going to live forever. They just want to do what they want to do, whatever that is, without worrying about everything they do. That freedom is worth so much. Like, you can't put a price tag on what that freedom is, that happiness, knowing no matter what, you're going to be okay, no matter what, you'll never fail, no matter what, you can do the things you want to do. I mean, that freedom is priceless, and most people don't have it, and don't even know they can have it.
It's funny, Paul. I was listening to you. I'm thinking to myself. So those people in their 70s and 80s, if they're listening right now, they know exactly what you're talking
It's a
about,
great That's
wanting
right. Right.
and wishing they had freedom. Those people in their 50s, we call you guys the invincibles after the greatest bull run in market history and compound interest at the tail end of your careers. You guys are way overconfident, confident. You're at the peak of the Dunning-Kruger effect, as they would say, the peak of Mount Stupid. Um, they don't, what do you mean freedom? What are you talking about? So the things that people don't recognize is in your 60s, anxiety will start to begin to expose itself. And it exposes itself for two reasons. Your relationship with money is going to change because now someone else isn't paying you. You have to pay yourself. So your relationship with money changes. That's one. Two is cognitively things start to change. We know 15 to 20% of people, 15 to 25% of people will have measurable cognitive decline in their 60s, usually around mathematics first. That's at least what research tells us. In our 70s, measurable cognitive decline is like 35% of people. And then in our 80s, it gets up to 70 plus percent. And you're a psychologist. I'm telling the psychologist the numbers. He knows the numbers, but that's the point. By the time they realize the search for freedom, they don't know. The 50s and 60-year-olds don't know what we're talking about. Just do yourself a favor. Go to an 8-hour educational course so you understand how to choose the right teams and what a real comprehensive plan looks like. We're a charity. We're not we're not here to sell you anything. We're educating you so you can go find the right teams. Then what you'll learn in the class is that through the education, understanding the risk mitigation levers that should be in a plan, and if you have the right team, will be in your plan, you will have the freedom to spend 6, 7, 8, 9% and not worry about outliving your money. So again, all we ask is a $29 donation to charity. If you'd like to attend one of our courses, go to retirementplanningedu.org. That's retirementplanningedu.org.